Ray Dalio. If you're not familiar with him, he's a pretty big deal in the world of money and investing. In fact, he's worth around $20 billion. That's a lot of zeros. So what's Ray Dalio been up to lately? Well, his company Bridgewater is actually the #1 largest and most successful hedge fund in the US. And with over 600 hedge funds in the US, that's no small feat. But he has bad news for you guys. Recently, Ray Dalio has sent out a terrifying message, and you need to hear that. Do you want to know what he has to say? Then stay tuned till the very end of the video. Now, we all know that investing in 2022 was a bit of a rollercoaster ride, and we're all hoping that 2023 will be the year that turns things around. And when it comes to figuring out where to put your money, it's important to listen to what the big investors are saying. But here's the thing, I think it's even more important to pay attention to what they're actually doing with their money. So let's take a look at what Ray Dalio has been up to. In a recent interview, Ray explained that we're currently in the 12th and a half cycle since 1945, and he talked about how these cycles work and how we often see a funky economy, weakness and distribution of wealth during these times. And of course, with COVID and potential changes in 2020, we saw exactly that. But what's Ray been doing with his own money? Well, he's been making some major moves with Bridgewater. They've actually done some major reductions and gone into cash. In fact, Ray has said that the cash cow is now attractive, which is a big change from what he said in the past. So what does this mean for his investors? Well, it's definitely something to pay attention to. Ray Dalio is known as the classic smart money, and he's clearly not optimistic about the next 6 months. In fact, his moves into cash should be a big warning to all investors. Now, I know investing isn't always rainbows and butterflies, but it's important to stay informed and make the best decisions for your financial future. Firstly, it's true that the government had to send out a lot of checks and the Federal Reserve lent the money to them. This has caused an imbalance in the system and led to inflation. Now we're seeing a classic cycle of stimulation, credit becoming debt, inflation and monetary policy tightening. Recently, Ray Dalio has changed his tune on cash and is now saying that it's very attractive. This is a big change from his previous statement that cash is trash. He's also been betting on the banks and is expecting major reductions. This is a warning to investors that the smart money is preparing for some kind of big storm. Bridgewater, for example, is laying off almost 10% of their employees, and other major companies are doing the same. It's important to keep in mind that these changes are part of the natural ebb and flow of the financial market. While it can be worrisome, it's also an opportunity to reassess your investment strategy and make any necessary adjustments. Recessions are a normal part of the economic cycle, but they can be painful for investors. During a recession, businesses may struggle to make money, leading to layoffs and decreased consumer spending. This can cause the stock market to decline as investors become more risk averse and move their money into safer assets like bonds or cash. That's why it's important for investors to be prepared for the possibility of a recession. This means diversifying your portfolio across different asset classes such as stocks, bonds and cash. It also means being patient and disciplined, as the stock market can be volatile during these economic uncertainties. But it's not all doom and gloom. Recessions can also present opportunities for savvy investors. For example, during a recession, stocks may be undervalued, which can create buying opportunities for long-term investors. Additionally, interest rates are often lowered during a recession to stimulate the economy, which can make borrowing cheaper and boost certain sectors such as real estate. In short, while a recession can be challenging for investors, it's important to keep a long-term perspective and remain disciplined in your investment strategy. And if you're feeling uncertain or overwhelmed, don't hesitate to seek the advice of financial professionals who can help guide you through these challenges. Dalio is a highly respected investor and the founder of Bridgewater Associates, one of the largest hedge funds in the world. He's often referred to as the $20 billion man and is known for his expertise in macroeconomic trends and monetary policy. In the past, Dalio has been a vocal critic of holding cash in his investment, famously stating that cash is trash in a world of low interest rates. However, with interest rates on the rise at a historically fast pace, Dalio is now singing a different tune. He's now saying that the cash is becoming more attractive as a store of value and is betting on the banking sector to perform well in the coming months. This shift in perspective from someone as influential as Dalio is definitely worth paying attention to, especially when you consider the recent layoffs at Bridgewater and other major companies. It's clear that the smart money is preparing for some kind of economic storm, and investors should take note. Bridgewater Associates, one of the most well-respected money managers on Wall Street, recently filled its Form 13F with the SEC. This document gives us a glimpse into what Ray Dalio and his team have been buying and selling in the most recent quarter, and it looks like they've been selling a lot. Out of Bridgewater's top 50 holdings, they reduced stakes in 44 of them. This is a significant move, especially when you consider that these are time-tested companies like Procter & Gamble, Johnson & Johnson, PepsiCo, Coca-Cola, Costco Wholesale and McDonald's. They are generally considered to be safe havens, companies with strong branding power, but even they weren't safe from Bridgewater cuts. What's even more concerning is that Dalio is known as the $20 billion man who the central banks turn to for advice with money. He's historically said that cash is trash in a 0% interest world. However, now that interest rates have risen at the fastest rate in history, he's changing his tune and is now holding on to cash. It's a clear warning to investors that smart money is preparing for trouble in the not too distant future for stocks and the US economy. In the interview, Ray Dalio, the founder of Bridgewater Associates, recently spoke about his views on the current state of the market. He cautioned against attempting to time the market, as it's difficult a task that even the most skilled investors struggle with. Instead, he emphasized the importance of investors understanding the need to balance their portfolio and not relying solely on cash, as it's not a safe investment due to inflation. Dalio also discussed the relationship between different markets such as equities, bonds and gold, and how they can affect each other. He recommended that investors know how to balance these investments in order to reduce risk without sacrificing returns. He acknowledged that even the most skilled market timers cannot predict how external factors will impact the market. Furthermore, Dalio discussed the importance of earning more than you spend and maintaining a healthy balance sheet. He explained how being a reserve currency can be advantageous for a country, as it allows for borrowing and creating debt. However, he warned that history has shown that currencies can be devalued or destroyed, which can lead to a shift in the store of wealth. Dalio has also touched on China's role in the global economy and how the transfer of wealth is occurring. He stated that he knows China well and has a perspective that allows him to understand the country's position in the world. Ray Dalio believes that investors should focus on balancing their portfolios and not attempt to time the market. He also stresses the importance of earning more than you spend and maintaining a healthy balance sheet. However, it's important to keep in mind that no one can predict the future with complete accuracy. While there are certainly warning signs of potential recessions or market corrections, there are also many factors at play that could impact the direction of the economy and the stock market. As always, the best approach for investors is to stay diversified and disciplined in their investment strategy. So if you're a new or tenured investor, it's important to make notice of these warning signs and consider your own investment strategy carefully. And if you're feeling uncertain or unsure about it, it's a good idea to go with a consultant and a financial professional who can help guide you through the times. And that's all for now. Hit the like button to show your support for our work, and also keep in mind to press the bell icon and subscribe to the channel to never miss any updates from us. We'll be right back in the next video. Thanks for watching.